Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to talk about Brookfield Investor Day announcements, including the special distribution of Brookfield Company, which is just spinning off their asset management business. I will also talk about what I am going to do with the new shares I receive from Brookfield, and also I will review the Brookfield management perspective on the overall economic conditions in the next few years, which is very interesting. Brookfield is one of the largest positions in my tax-free saving account, and as I mentioned in the previous videos, I definitely believe in the company and the management team of Brookfield. They have more than 100 years of experience managing and operating conventional and alternative assets in more than 30 countries around the world, with a whopping $750 billion of assets under management across real estate, infrastructures, renewable power, private equity, and credit. Therefore, I believe the Brookfield management take on economy is definitely something you want to consider listening to, and in the second part of the video, I will briefly go over the analysis of the general economy in the world. In the first part of the video, I will focus on two important news which announced in the Investor Day presentation. First news was the Brookfield's agreement with Intel to jointly fund construction of a semiconductor facility in Arizona. Brookfield management view this investment as a wise move, as in their view, semiconductors will have an essential role in the global economy, especially due to potential of deglobalization and supply chain disruptions in the future. I agree with their take, and I think this would be a great investment with a potentially great return in the long term, which is something that I love about Brookfield, as they think really long term when making an investment decision. The second news was the special distribution of Brookfield. In the Investors Day's presentation, Brookfield announced that they will distribute 25% of their asset management business to the investors. So I simplified the process of this special distribution here. If you own 100 shares of BAM-A before the distribution, like me, you will receive 100 shares of Brookfield Company with a potential ticker symbol of BN. This is the main company stock which holds ownership in all of the Brookfield sub-businesses like infrastructure, real estate, renewable energies, and asset management. And then on top of 100 shares of Brookfield, you will receive 25 shares of asset management business with ticker symbol BAM. For one share of BAM, so basically 1 share of BAM for every 4 shares of Brookfield that you own. The main reason Brookfield wants this spin-off is that after a spin-off, the asset management part of their business can be better understood and appreciated by the market. And they also want to provide better growth opportunities for this part of their business while allowing investors to invest directly in asset management activities. Brookfield is really good at dividing their business into smaller sectors, and they did this successfully with their infrastructure and renewable energy businesses in the past. While I love the idea of having different sectors of the business as individual companies, I personally decided to sell all of my asset management shares after this distribution and buy more shares of Brookfield Company instead. I like the idea of investing in the core business and not investing in the individual sectors of Brookfield. If I had to choose only one sector of Brookfield, I would probably like to invest more heavy into infrastructure part of their business. And for that reason, I will just buy more Brookfield shares with my asset management shares. In the last part of this video, I want to briefly touch base on Brookfield management view on the economy in the coming years, which is really interesting. So they started with talking about inflation, which is at its 40 years highs in the most countries around the world. It is close to 8.5% in US, close to 10% in UK, close to 9% in Eurozone, with a core inflation of around 6% in US and UK, which is really high. They believe we are in a turning point in the history when we are shifting from globalization to fragmentation as the results of COVID-related policies around the world, from free trade to weaponization of economy, most importantly from efficiency to resilient. They believe central banks around the world should face new realities like the consequences of deglobalization and inflation, and the trade-off between inflation and growth, which is directly related to having a good labor market with low unemployment rates but more competition for available position, and as a result even more inflation. It is obvious that globalization means disinflation and deflation, as we have access to increased competition in products and labor markets. But with fragmentation, we will have less competition in products and labor markets, and therefore basically higher wages and inflation. As a result of higher prices of capital and fragmentation in supply chain of the world, the real interest rate increases which leads to tighter financial conditions in the long term. Here we can see that in the last few quarters, not only earning per share growth rate of S&P 500 companies diminished, but also the valuation of these companies also reduced dramatically as a result of raising interest rate, and therefore equity discount rates. Discount rate is exactly what I use in my discounted cash flow models, and if in a low interest rate environment you will be happy with 4-5% return on your investment, in a high interest rate environment when you can get 3-4% via GICs or saving accounts, you will be happy with 9 or 10% return, not 4 or 5% return. So 9 or 10% return in riskier capital markets is what you will aim for, and that's why your expected rate of return increases and the price of stocks, of course, decreases. Brookfield management predicts that the downturn in the economy is likely, but the timing and magnitude is uncertain. Overall, they believe this is not as bad as 2008, and it is not similar to 2001, as the conditions in the economy and world are different. They predict we will have a shallow downturn, and the magnitude is highly dependent on Russia-Ukraine war and also central banks. They finally make the conclusion that the best investment in the current financial environments are the ones with high quality assets, which will form the backbone of the global economy in the coming years. I think we can all agree that the highest quality assets and businesses will always survive economic downturns, and that's exactly what I'm trying to do with my investments. I only invest in quality businesses, and I pay a fair price or under fair price for those businesses. There you are, guys. I hope you enjoyed the video, and if you enjoyed this video, consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.